This chart is a visual guide to how institutional traders identify and trade a bearish order block, which is a special type of supply zone where large professional orders have previously triggered a strong downward price move. In the middle of the image, you can see a wide gray rectangle labeled Bearish Order Block Zone. This zone represents the final group of bullish candles, the last push, upward immediately before the market dropped sharply. Those bullish candles are significant because they show the point where powerful market participants, such as banks or hedge funds, finished accumulating their short positions. The reason price fell so strongly afterwards is that these big players entered large sell orders, and when those orders were triggered, the market had no choice but to move rapidly down as supply suddenly exceeded demand. After the strong bearish impulse, price does not continue down forever. Instead, it begins to retrace or pull back, forming a series of higher lows and higher highs until it rises once again to the level of the gray zone. This slow upward retracement is often a sign of weaker buying pressure. Retail traders and smaller participants push price upward, but the institutions that caused the original drop are waiting patiently at their previous sell zone. When price finally touches the gray order block zone again, we have what is known as a retest. The retest is crucial because it tells us whether the original sellers are still active and whether unfilled orders remain. Professional traders look for evidence of rejection right at this point. This can be a sudden loss of upward momentum, the appearance of a bearish engulfing candle that closes below the order block, a pin bar with a long upper wick showing failed attempts to break higher, or a surge in trading volume as sellers once again dominate. In the diagram, a red arrow points to the moment when price makes contact with the zone and begins to stall, and the label Execute Sell highlights the textbook opportunity for opening a short trade. To manage the trade safely, a disciplined trader will place a stop loss just above the highest point of the order block, often adding a small buffer to protect against quick spikes or what is known as a liquidity sweep, where institutions briefly push price above the zone to trigger retail stops before resuming the drop. The profit target is typically set at the next clear support area or the previous swing low, ensuring a favorable risk-to-reward ratio such as 1:2 or better. Many traders also watch for confluence from other technical tools to strengthen the signal. For example, a Fibonacci retracement level lining up with the order block, a downward trend line crossing the zone, or momentum indicators like RSI or MACD showing bearish divergence. It is also important to remember the role of multiple time frames. Bearish order blocks identified on higher time frames, like the 4-hour or daily chart, carry more weight because they reflect the actions of large market participants and are less likely to be random noise. Traders often locate the main zone on the higher time frame and then drop to a lower time frame, such as 15-minute or 5-minute charts, to find a precise entry once price begins to reject the zone. This top-down approach combines the reliability of large-scale institutional footprints with the precision of lower time frame execution. This concept highlights how the market often behaves like a battleground between large institutional players and smaller retail traders. Institutions create the order block when they place massive sell positions, drive price sharply lower, and later defend the same zone when price revisits it. By recognizing the telltale footprint of a bearish order block and waiting patiently for a clean retest and confirmation, a trader can align with the momentum of the strongest market participants rather than against them, greatly increasing the probability of catching a profitable downside move. This chart is a visual explanation of a break of structure, often abbreviated as BOS, which is one of the clearest signals that market direction is changing. At the top of the image, you see the title Break of Structure, and across the middle, a horizontal green line connects two important points. On the left, the arrow marks the previous swing high, which is the highest point the market reached during its last upward attempt before turning down. From that high, the price fell and formed a sequence of lower candles, creating a short-term downtrend. After reaching a bottom, shown by the cluster of red candles followed by green ones, the market begins to climb again. As the green candles rise on the right side of the chart, price eventually moves above the horizontal green line that represents the level of the previous swing high. The small label, break, shows the exact point where a bullish candle closes beyond that high. This is the break of structure. It signals that the previous bearish structure of lower highs and lower lows has been invalidated, and that buyers are now strong enough to create a new higher high. For many price action traders and smart money traders, this event is the first formal confirmation that market sentiment has shifted from bearish to bullish. Once the break is confirmed, traders look for an opportunity to enter a long position. The diagram's green arrow and the box labeled Execute Buy highlight the suggested area where a trader would open a buy trade. A typical trading plan would be to place the stop loss just below the most recent high or low, or below the breakout candle to protect against a false break, and to target a logical resistance or the next key swing high for profit. Traders often add confirmation tools, like a surge in volume on the breakout candle, bullish divergence on momentum indicators such as RSI or MACD, or alignment with a higher time frame uptrend to increase the reliability of the signal. This concept is important because market structure is essentially the roadmap of price movement, a series of swing highs and swing lows that defines trend direction. When a previous swing high is broken and price closes decisively above it, the market shifts from making lower highs to making higher highs, marking the start of an uptrend or at least a bullish correction. Recognizing a break of structure early allows a trader to position on the same side as the emerging trend, joining the momentum created by the buyers who have just proven their strength. This chart shows the concept of a fair value gap, often abbreviated as FVG, which is a key idea in smart money trading for spotting hidden imbalances in price. At the top of the image, the title Fair Value Gap sets the theme. In the middle left, you can see a highlighted gray rectangle, labeled Bullish FVG. This rectangle marks a specific area between candles, where price moved so quickly in one direction that it left behind a gap or thin zone, where very little trading took place. Such a gap is considered an inefficiency or an imbalance between buyers and sellers because price did not have time to trade fairly across all levels. To understand how this gap forms, notice the sequence of candles leading into the gray area. A strong bullish move, shown by a large green candle, pushes price upward so rapidly that the next candle opens well above the low of the candle 2 bars back, leaving a space between the first candle's high and the third candle's low that is not overlapped by the middle candle. This empty space is the fair value gap. Market theory suggests that price often returns to these unfilled gaps later, because professional traders and institutions like to rebalance the market by filling areas where few transactions occurred. In the diagram, after the initial rally, price begins to retrace downward with a series of red candles. Eventually, it drops back into the gray zone, the bullish FVG. This is the key moment smart traders are waiting for, because a revisit to the gap is seen as an opportunity to join the original bullish move at a fairer price. The green arrow and the label Execute Buy point to the point of entry, where price touches or slightly enters the gap and shows signs of stabilizing. This is where a trader would typically open a long position. A prudent trading plan would include a stop-loss placed just below the bottom of the gap or beneath the most recent swing low to guard against a deeper correction. Profit targets might be set at the recent swing high or at the next resistance level, aiming for a favorable risk-to-reward ratio. To strengthen the trade idea, traders often look for confluence. For example, bullish divergence on indicators such as RSI or MACD, or alignment with a higher time frame uptrend. Some traders also wait for a confirming bullish candlestick pattern, a strong green candle closing above the gap, before entering. The reason this concept is valuable is that fair value gaps represent the footprints of aggressive institutional activity. When big players enter the market with heavy buy or sell orders, price can move so fast that not all levels are efficiently traded. Over time, price tends to revisit these levels to fill the gap and balance order flow. By identifying a bullish FVG, waiting patiently for price to return, and then confirming that buyers are stepping back in, a trader aligns with the same smart money forces that created the imbalance in the first place, allowing them to capture the next wave of upward momentum. This image represents a system architecture flowchart, which visually explains how the entire trading strategy system is designed and executed. Let's break it down step by step. At the very top, the process begins with initialization. This is the starting point where the system sets up all the required components, such as market data feeds, account connections, and essential parameters needed for trading. Once the initialization is complete, the system moves to the strategy block. This is where the main trading strategy is defined and selected. From the strategy, the flow leads into Star Auto, which stands for an automated strategy selection process. Here, the system decides whether to apply a specific trading approach based on market conditions or predefined rules. After this automatic filtering, the architecture branches out into 3 possible strategies: Star OOB, Star BOS, and Star FVG. Star OOB represents the order block strategy. If the system identifies an order block setup, it proceeds to trade OB, where actual trades are executed based on the order block rules. Star BOS represents the break of structure strategy. If this condition is detected, the system moves to trade BOS, where trades are placed according to structure break confirmations. STRFVG stands for Fair Value Gap Strategy. When a fair value gap is identified, the system proceeds to trade FVG, executing trades that capitalize on price imbalances in the market. Each of these trade execution points loops back into the system, meaning once a trade is completed, the system resets and continues monitoring the market for the next opportunity. In simple terms, this architecture shows how the trading system starts, selects a strategy, and then executes trades based on 3 core methodologies: order blocks, break of structure, and fair value gaps. It ensures that trading decisions are automated, structured, and repeatable.